Hi guys, it's Ben Wakely here coming to you on Sunday the 9th of April. Hope everyone's had a great weekend. We're smack bang in the middle of school holidays for most people. So this week, just to report in, we still had some pretty good steady inquiry. But, it's been a little bit quieter, with the school holidays being on and then Easter upon us, which is next week. So next week we'll be coming to you from Noosa, for the Easter long weekend. So looking forward to that. Guys, I thought I'd just tonight run over a few things that have been coming up a lot lately in the news. And as my business partner says, they don't sell newspapers by saying there isn't going to be a bust and, we've got a massive debt problem and, all the doomsdays out there. And I sort of touched on that in my last live, and I also touched on that as well with, some of my clients. Look, the market at the moment is very steady in Brisbane. We're finding we're getting good, steady numbers through the open houses. Again on the weekend we saw some good numbers, but it was pretty reflective of the holiday period where they were good and steady, but not through the roof. Guys, just to go back, if everyone can hear me all right tonight, just give me a thumbs up and let me know if everyone can hear me all right. So, look, the question that has been asked of me with all the, every time you turn to TV on this week about, APRA coming down and as far as banks tightening on lending is, what is the best loan for you? And the restriction on banks, coming in and making it, the interest-only loans, not as easy to get anymore, and a few are tightened up totally on them. So, look, the best type of loan for you depends on your circumstances. Now, if you're buying a home for yourself to live in, I'd strongly suggest to do a P&I, which is principal and interest. So when you hear the word P&I, that stands for principal and interest. It allows you to pay off your home sooner and also just not rely on just paying the interest, because if you're just paying the interest only, and the market, and there is a little bit of a market correction, or the market isn't going up at a steady pace, yes, you do own the property, but you're still realistically paying rent. So your principal place, like, for Sam and I, for our instance, we've paid massive amounts off our home loan over the last few years because, it's not a good debt to have. You can't get any tax deductions from it. So when people pay interest only, I'd suggest that more for your investment properties. But be aware, if you are doing that for your investment properties, just make sure that that you do have enough built into the property as well, enough price built into the property, so that if there is a little market correction, that you can definitely sustain that. So look, I know some banks lend up to 90%. So in other words, on a $500,000 house, you come up with $50,000 deposit or the equity from another property. Look, I think to play it safe, I'd always suggest at least a minimum of 20% deposit, and I would suggest that that's just in accordance with bringing the payments down and also having that little bit of security in there. Using the equity is an interesting one. Obviously, you'll have to get this advice off your, bank and, your broker or whoever you use. I'm just giving it the advice tonight based on my own experiences in buying 25 properties and, and keeping some. And I've done all sorts of loans. So, there's even ones where you can, fix the loan or fix half the loan and, pay half the loan off. So it just brings down the component that you're paying off. So it just brings those monthly repayments down because, obviously you need to live. So I think people sometimes play the short game and just think, look, they only have to pay a certain amount a month. And at the moment, don't forget, we're at all-time lows on interest rates. So banks are starting to edge them up. It's only a matter of time. I bought my property, my first property in 2000, and that property I paid 4.59%. The current property I live in, I bought in 2009, I was paying 8.65%. So it's very, very important to make sure that you are aware that the current cycle of interest rates will not last forever. I don't believe that they will, go up at a rapid rate, but you've got to be wary of what you pay now in interest. You will not be paying, down the track, and I don't think they'll go any lower. It's pretty safe to say. So just always do your maths on at least double. I always do my maths on 8% because I've paid that much amount before for my own property. So I always base my repayments on if I can cover 8%. So, at the moment, obviously, I pay anything extra goes off my primary place. And that's not a big loan at all because I started doing this years ago. So the loan on that's very, very small. And the loans on the investment properties and commercial properties that I own, they're more the interest. But, we came up with the 20% deposits on them. But all the deductions that go along, you don't want to be driving your extra money into that when you can look at other investments. So that's the breakdown. So as I said, for your primary place, I'd strongly recommend that you're in a position to be able to pay principal and interest. I believe if you can come up with 20% deposit, I think that's going to put you in a really good position. I think you should also consult your broker or your bank. It just depends on who you've got the relationship with there, because the last thing you want to do is rock up to an auction and buy a property and not be able to finance it. So there's all those sort of variables in there. And as I said, you can be crafty. Just recapping, you can be crafty with your loans. You can also do half fixed, half principal and interest, and you can do half, interest only. So it just depends on how much of a loan, and it depends on your goals. But everyone I'm dealing with at the moment, and I'm talking to a lot of people, is playing the long game. So, with property, we talked a few weeks, or probably my first ever one, I think it was about 5 weeks ago now, we talked about playing the long game and your transactional costs. So, view property as a long-term investment. And I think if you just make those extra repayments and have it on a variable and not a fixed rate, and just have it on a variable, and every time you get that little bit of extra money, you put it on the home loan, it goes a long, long way to paying your home off sooner and puts you in a comfortable position. And when you've got all these people in these doomsdayers out there at the moment that are talking about a bust, it doesn't matter because you've put yourself in a really good position, and being in that good position doesn't mean that you're still going to have a roof over your head. And the other thing too is with rising interest rates, we also see less investors in the market as well. So they'll tend to move their money out, and we're already seeing a little bit of that. Not too much, but we're seeing a little bit of that throughout certain sectors of the market. So what that'll do is take investors out. So what that does is, literally people will sit on their investments, and rents tend to go up in that period because there might be less people that are able to buy or in a position to buy, or have the means to buy as well. So what you'll find is people will, the rents will go up over that period. One of my properties was rented at $1,300 a week at the top of the cycle when interest rates were higher. And then when the interest rates went down, it was rented at $900 a week. So that's $400 a week difference that I was getting, and that was just due to there being less renters in the marketplace and more people buying property than renting. So again, if rates do start creeping up, investors sneak out, more people trying to rent, it becomes a lot harder and competitive to rent. So that starts to knock the rental prices up. So the rental returns start getting higher, but your property price mightn't increase as much because there won't be as many buyers around. So it's one big cycle. I believe I had a couple of questions, Sam, that came through as well.
I've got one here from Renee.
Yes, Renee. How are you tonight, Renee?
There is a lot of negative sentiment in the marketplace at the moment, in particular borrowing for investment or owner-occupier properties. The banks keep changing the goalposts, so what would be the minimum deposit required on purchasing?
Thanks very much, Renee. Look, thanks for your question. Again, I sort of covered that a little bit there. Look, I spoke with a lender during the week, and they were, willing to lend on, just a 10% deposit. My recommendation would be 20%. Banks are definitely tightening up as far as lending goes, as far as investment goes. So, for example, look, I'll throw some figures out there. You might pay 3.95% on your home loan, but your investment loan might be at 4.2, 4.3. So there's a difference between what the banks will, what interest they'll charge on those loans. So yes, they are, tightening up on the investors. This is just another way, I think, to slow Sydney and Melbourne down. In my opinion, I think they're just trying to take a few investors out of the market to allow a few more owner-occupiers to buy. They definitely haven't made the move yet to slow that down, but it's definitely being talked about. And there's a lot of doom and gloom. But guys, as I said, you've got to have a crack in life. So you can sit on the sidelines and wait for this bust that everyone's going to talk, is talking about, that's going to happen. But look, at the end of the day, I wouldn't be too concerned out there at the moment with as far as us falling off the edge of the cliff. I know Sydney and Melbourne have had really, really good growth, but again, to all my audience out there, play the long game. Brisbane's had really good steady growth, around that sort of 3 to 5%. I read an article during the week that said Brisbane was going to be between 5 and 7.5% this year. So good steady growth. Obviously we've had boom times and little corrections, but if you can, even in the corrections, it's really only, I've sold a property that these people bought recently. I can tell you a story now. They bought it basically in the boom, and they tried to sell it a couple of times, and we've resold it recently for about the same price that they bought it for. So when it did come down, we did try and sell it a couple of times in between when they bought it and now, and it probably came back about 10 to 20%. So call it 15%. So that's why I say that if you do cover yourself with about 20%. I think you'll be pretty fine to be able to get out of it. Look, because look, life does throw curveballs at you, and you do want to have to, if you do have to sell something and you need it, you want to be able to get out of the loan, and that's why I suggest that historically. It's a lot better to be on a variable rate than a fixed rate. Just it gives you more flexibility in case you need the money and need to be a little bit more liquid. So I'd be strongly advising everyone out there to be on variable. I know some people at the moment are wanting to lock in these low fixed rates. Nothing wrong with it, but just bear in mind if you break a fixed rate, there's break costs involved, and I've heard of stories of that where it can cost around about $10,000 if you're not far into a fixed rate loan, or if you sign into a fixed rate loan of 5 years, you can break that, and it's not a pretty sight when you've got a pretty big bill on top of it as well. So just any other questions we got coming through?
Just on the fixed loan, I have a question here from Xander. If you have a fixed loan for 3 years and sell in that time, is there a break fee?
Yeah, sorry, so Xander's asked that. So yeah, we did just cover that then. So there would be a break fee. That depends on your bank. But there is, if you have a fixed loan, and if you're going to sell in 3 years' time, that's a real short vision unless you're a builder or a developer that's trying to do a quick turnaround. The odds of you making a really, really good amount of money off the property is pretty low, and you definitely will have some break costs involved in that. And again, it depends on the size of the loan, depends how much interest you're paying. But on a 3-year fix, it could be $8,000 or $10,000 or something like that.
Next question is from Colin.
Hi Colin, how are you tonight?
I'm buying an investment property. What should I do? Principal and interest, or interest only?
Okay, Colin. So, look, Colin's asked if he's buying an investment property, if he should be interest only or principal and interest. Recapping, I think earlier we covered that. I think you should definitely be paying principal and interest and paying as much principal off as you can and paying it every 2 weeks. Instead of every month. I think that would be a lot better. If you're doing for your investment property, I think if you can come up with the deposit or use the equity, but I'd definitely, try and put some sort of cash component in there, Colin. I think that would be a lot better to be interest only because of your tax deductions there. That's definitely the better option of the two with your investment, because with the money left over that you have on your investment property, you can then put that into your own primary place of residence, which I think's a great thing to do, because as I said, you'll notice a difference, even if it's a few grand here and there. Over a year and over a couple of years, time flies. Sam and I are only just talking about this today, how quickly time flies. You can own your home sooner. And stop paying, money to the banks, because that's where they make their money from, is from the interest. And the less interest you pay, the more that you can pay off your home. So the more that you can go out and reinvest that money somewhere else. Or if you feel like going on that holiday that you've always wanted to go on, you've got that extra bit of money covered. So try and knock off your home loan as fast as you can. You don't want to be having large large loans on your house that you live in, because you just don't get any benefit out of the interest you're paying. It's basically just paying a little bit of rent as well. So you want to be able to make those extra payments. And again, if you can make them fortnightly instead of monthly, it's going to really cut down the size of the time of your loan and the amount that you're paying. And I'll see some astronomical figures as far as the amount of money that you'll save over a 25 or 30 year period, however long your loan is for. It definitely makes a big difference.
Next question is from Philippa.
Yes.
Right.
Yep, Philippa. Yep.
What sort of deposit do I need to purchase a property valued at $750,000?
Okay, so Philip has asked what deposit on the 750. Look, on a $750,000 property, some banks will be asking for 10%. But I think if you can come up with 15 to 20%, I think that would put you in a good position. And then being an investment property, with the rents in these areas where I work, which is in the inner western Brisbane, I think that should pretty much cover most of your costs there and cover your monthly repayments. So again, 20% of 750s, is basically $150,000. So that's what I would be coming up with, Philippa. Again, it just depends on what other investments you have, whether how much you owe in your own home. But again, look, there's a scenario there. You might only pay 10% deposit on the $750,000 property that you're purchasing, and the other $75,000 that you have may be better served in paying down your own home loan, your own home quicker, so you've got less money tied up in the investment property. So there's a couple of solutions that I hope might help you out there.
Next question is from Darren.
Yes.
Do you think buyer's agents will become standard in all transactions in years to come?
Very good question, Darren. Thanks for asking that. I started real estate, guys, again in 2001, and there weren't too many buyer's agents around, but now there's more than ever than I've seen. I'm definitely referring a few people to buyer's agents, because buyer's agents have access to a lot of properties. They have access to properties with all sorts of agents, and it doesn't matter which area it's in. So buyer's agents are definitely around more now than they were when I first started. And they can take a lot of the hunt out for you, and go to those open homes and give you back your weekends. as well as, search for off-market transactions. So I definitely would, recommend the services. There's plenty of really good buyers agents around, and they do a really good job. I think they're worth their fee totally, and I work closely with a lot of them, and they do a great job. They build relationships with agents that you mightn't have. There's people from overseas that need them to go and be their eyes and ears, and they have a really good understanding of the market. And, as I said, I've got the utmost respect for them, and, the buyer's agents get paid by the buyer, so there's no conflict of interest as far as that goes. So I think employing a buyer's agent's a very good idea. Obviously, if you enjoy it as a hobby, but, as I said, I've seen some people looking around for 12 or 18 months looking for a house, and, some of these entry-level houses in Paddington, for example, have gone from, 650 or 600,000 over the last few years to now being, almost around 900,000. So, they've missed the boat a little bit. So that was a really good question, Darren, and I definitely, if you don't have enough time and you're both working, say a husband and wife, and you've got children, I definitely would recommend you use a buyer's agent, or, if you can't make those auctions, have them bid on your behalf. And, I'm bidding on someone's behalf soon as well, so I'm happy to do that. But yeah, I think buyer's agents have a really good reach on a lot of different properties. If you just go to one agent, like come to me, that's fine, but I only can tell you what I, knows on the market, or what I know is on the market within our office, or, I can let you know what's on the market with other agents, but there's plenty of off-market transactions happening, so a buyer's agent is more likely to know about that. So Darren, yeah, definitely using a buyer's agent is a good advantage, and I think there'll be more of it to come. I think it's really big in America, where it's part of the transaction, and there's always someone representing the buyer with most of the transactions over there. So I think it's only a matter of time before more and more buyers agents are part of the transactions. And as I said, I'd probably sell about 30 or 40% a year to buyers agents. So yeah, very good to deal with. Now, guys, I hope you hope that covered a few points, and as I said, there's been a lot of press out there in the last couple of weeks about where interest rates are, and the types of loans that banks are willing to do. I hope this gives you enough information going forward. Again, I do receive a lot of private messages and phone calls and emails after these Sunday night chats. So please feel free, if you've got any more questions, I can definitely help out, and I'm more than happy to help out, and I'll get back to every single one of you, as I have done in the past, and I look forward to seeing you next week. And next week's Easter Sunday, so I hope everyone has a safe and great break, and I look forward to seeing you next Sunday. Thank you.